glad we got a mixture of students. I know we put it out there. I'm glad there's someone from law because, I mean, there is a touch of law, accounting, finance, and like I said, creativity. I know it's hard to believe, right? But economics does involve some levels of creativity because everything's kind of subjective from a perspective type of view. So people that are creative actually do well. In fact, our other colleague, Steve, he's I can't remember what his undergrad major was. Huh?
French literature.
That's right, French literature. Didn't even study anything in the business like sciences realm, right? But got pulled in there somehow. So obviously we're going to be talking about principles of transfer pricing today. Like I'm supposed to be like giving the foundational concepts of like what it is, how it generally works, why it exists at a level that's just conceptually understood because part of the case that comes later, right, will kind of test that knowledge and subject. I created this deck for you guys to use as a reference point. It hopefully has enough, right? It obviously doesn't cover all the ins and outs, but with GPT and Google now, with that kind of keywords and phrases, you could definitely use it to kind of help get into an understanding. So I won't cover everything in here because it is dense, but I want to leave rooms for questions at the end and everything. I care more that if there's a conceptual question that you guys have as we're going through it, that you ask it and we kind of dig into those pieces more than just me running through a slide deck, because I know they can be exciting, but most of the time they're not. So I don't want to lose you guys halfway through. That's all I'm saying. I don't want to lose you halfway through. So, I mean, that's just the basic agenda. Okay. Any questions before I start, though? I guess I'll say that. No. Who looked through the deck before you came? Okay, good. So then, some of it you'll have at least glanced over. Who had heard of transfer pricing before? Okay, good. I don't know if I've actually met some of you guys. I know we've had a few other things here. If I did, I'm sorry, I don't remember, but good. Okay, good. So we have a start. So transfer pricing, we'll start off with a basic question. If Apple designs an iPhone in the US, but manufactures it in China and then sells it in Europe, who should earn the profit on the sales of that phone? Take a quick vote. Okay, who thinks that the designing country, the US, should earn most of the profit with that phone? Okay, who thinks the manufacturer? You got chips, right? You got chips that are complicated. Sales country, Ireland, doing all the sales. Interesting. Okay, we got a good dispersion. Or, I'm kind of like pulling your guys' leg a little bit. It depends. Depends a little bit, right? Interesting question. People don't really think about that, right? You think about a company that's unified and it's got all these operations around the world. They're like, what do you mean profits being earned by each individual country? Like it's all Apple. Who cares? Go ahead.
Question on that. We do have a lot of different disciplines represented here. What do you mean by profit?
It's a good question. We'll get to it. Good question. No, don't worry. We'll get to it. But transfer pricing is about the allocation of that profit, right? Any business in this sense, I guess what I'm really talking about is like value that you create with the company, right? Obviously, the way any business works is you develop something, you create it, you sell it, and that sale is going to be worth more than whatever you put into it, right? The creativity and aspect of like making something new is that value creation that you get to take in the form of a dollar, right? But transfer pricing is all concerned about how you kind of allocate that profit on a multinational scale, because now you've got some implications when you're going cross-border. So I want you guys to think of transfer pricing as like a subway system. And I got a really crude graphic here, right? But you get the idea. The multinational company is like the subway network. You see here all over the place. Traffic that moves through this subway system is like value moving through the company, and you've got these different points. Stations, like those little white dots, are entities involved in delivering that product or service. Lines are the flows and goods between each of those stations. And transfer pricing is like drawing up the map and figuring out where do those lines need to run to and intersect in order to make the system work effectively. No, I would go back to this slide kind of after we get to the end because it'll start to make sense more. It's a good analogy. This is kind of dense, right? But I know there's a lot, and I don't have nice little transitions to lead through it because it won't do that for a table. But I mean, maybe the first one is like the second box is really a good one, but I mean, this is all economics based, regulated by tax laws, implemented through accounting. This is where we get the multidisciplinary aspect here, right? Econ is the conceptual aspect, taxation laws, kind of accounting and international laws, accounting procedures made legal through intercompany agreements and justified by analytics, documentation, and transparency. Okay, so why do you think we would care about transfer pricing? Kind of alluded to this already, right? But multinational firms operate as one business, but they report taxable profits differently in each jurisdiction. So intercompany transfer pricing affects what those taxable profits are in each jurisdiction. So going back to our original question with Apple, right? China's manufacturing, that's one. They've got to get raw inputs from somewhere, either from the company or from elsewhere. They manufacture and then sell it to Ireland, and they've got maybe marketing and salespeople that have to get paid there, and they'll all have their own profit and loss statement, their income statement of how well they're performing there locally, and that leads to tax, right? And then there's other concepts with accounting for people who aren't accounting here, withholding taxes and different ways the government likes to tax activity, right? Like just like we get sales tax and income tax, different activity that we do gets taxed differently. So governments want pricing to reflect economic reality. So think of this question. This next slide will help demonstrate it, right? But if internal pricing is set too high or low, think about what problems could arise. So here, very simple income statement for using the same example that we had talked about before, right? Got our revenue, cost of goods sold, operating expenses, down to a taxable profit level. Remember, we have Ireland who's selling iPhones, and we've got China that's manufacturing them, right? So first, I want you to look at the China side. So China's getting all of their raw inputs to make iPhones, right? That's what their cost of goods sold is of $100,000. They got operating expenses, people in the warehouses putting things together, all of that stuff, right? That $400,000 is what we call a transfer price because they're going to have to sell it to their own internal entity in Ireland to further resell us as customers, right? They're not selling it. I mean, they may sell it to other people too, but let's just say this Chinese entity is just selling to Apple Ireland. They're the whole supplier of that, right? So that 400,000 is a controlled transaction. That's something that they can call each other up and say, we're going to send you 100,000 units for $400,000, and they do that, right? Then you get down here, and this is essentially the total tax paid on a global scale, right? You've got 37,000 on both jurisdictions in this case. Think through this for a minute. If I change that 400,000 to something totally arbitrary, let's say it goes up 500,000, what do you think happens?
More taxes.
Yeah, tax situation changes, right? We go to the scenario B. Let's say we lower that price. China says like, you know,
That scenario.
I know. Well, you'd think it'd benefit us, right? It doesn't. It just how it benefits them internally. So you lower that price, they still have enough to cover their costs, and they're still a tax-paying entity. They're paying 12,000, and more taxes now being realized in Ireland. But you see this big differential right here? Ireland only has a corporate tax rate of 15%, and China's at 25%. So you lower your overall effective taxes paid by $10,000, multiply that times 100 because Apple's a billion-dollar company, and all they got to do is flip a switch, you know, in their accounting system. They're like, "Oh, great, you guys, we just saved 5 billion in taxes because we just flipped the switch everywhere." You think that's a problem potentially? You think governments would care that that's a problem?
Possibly.
Absolutely. Yeah, probably, right? I mean, I say that. I mean, there's court cases going on. Just search it. Facebook is on there. A bunch of these companies try to work the system as much as they can, just like we do with our taxes, right? Like, oh, I'm gonna deduct that, you know. Hope they don't catch me on. Okay. Okay, return to value creation. We're back to this same question. So obviously there's a vested interest in governments and societies to make sure that that price has some form of box around it. You can't just put whatever you want, right? So we go to these core principles of like what constitutes like what you can set that pricing to, right? One is like profit should be earned where value is created. That's like an underlying concept, same as like a risk equals return, you know, and right, greater the risk, the higher return you expect. It's kind of like a fundamental truth. So same thing here, saying profit should probably follow where the most value is created in a system. Where do you guys think value is created? I didn't mean to click this one, so you get the first one, right? How is value created in a system? I give you the first one, functions, what people do, the system. You guys think of other ways value is created besides functions?
Probably market power, just like the ability of like intellectual property. If I have a patent on something, then no one else can sell it. At least that's the theory of how it's supposed to work.
You're absolutely right. Assets. What assets do you control? Do you have intellectual property? Do you have factories? Do you have land? Do you have stuff that other people don't that help you create value out of something? There's one other thing. Okay, if you don't get it, it's kind of more obtuse, right? But risks. Like what could go wrong and who bears that risk? It's how you're allocating risk amongst your entities and who takes things. This is known as an FAR analysis. It's what we call in transfer pricing. You got to do a FAR analysis of functions, assets, and risks because those are essentially what the governments say are the fundamental inputs to indicating where value is created. So now we have these three. Which do you think matters more for profit slash value? Doing the work, owning the assets, or bearing the risks?
Probably bearing the risk is that's like the fundamental finances, like risk and return.
I did say that. You're right. Definitely a King. Any other?
It probably depends.
With that answer. I love it. You're in economics, right? Absolutely. If you never know an answer, you just say it depends. And you're going to be right probably 100% of the time. That's right. You're right. It depends. It depends on what kind of business you own. Depends what, if you have a really capital intensive business, it matters very much. Like if you're digging up gold, it matters a lot who owns the property that you're digging on, right? And the machinery used to extract it. If you're a technology company, who owns that IP? That's pretty much everything for technology, right? Anyone can copy code. It's whoever made the code first, right? So very good instinct from all of you guys. You're all technically right. It's all good. We have this other fundamental concept for profit and value that we call, which is like routine versus non-routine. It's exactly what it sounds like. I don't know if Stice isn't teaching here anymore, is he? I think he retired a long time ago. He's probably still got his videos up though, because there's some intellectual property for you. Right? He recorded himself and now he gets to teach while he's sitting in an island somewhere in Hawaii. But you have this, he would used to say, if you just say things slowly, that's why I brought it up. If you say things slower in accounting, you get it better, if it's this weird obtuse thing. But with value and profits, you have this concept of routine versus non-routine. It's exactly what it sounds like. You get routine profit for very standard, repeatable activities, things that generally speaking, most people could probably do, right? Non-routine profit from unique advantages. Intellectual property is probably the easiest thing, right? Things that are not repeatable, that are new and unique. Another concept in transfer pricing that helps you segment between value. This is kind of complicated because most people don't understand like this is how the world actually works. If you don't work in maybe a particular industry that has manufacturing, this is like a completely new concept for you, but it's just supposed to illustrate the idea of this routine versus non-routine. You've actually got like a continuum of types of manufacturers in a given system. The whole idea and concept, you have like your most risk-bearing type of manufacturer, what they call a full-fledged, and you got your least risk manufacturer, which is just a toll. Have any of you guys heard of these terms before? Maybe contract manufacturers. Most people hear contract manufacturers, right? Basically, the idea being like with a toller, more often than not, it's someone that just owns a machine that churns out something, right? And they're like grain, or something like that for making flour. Back in the old days, there used to be a guy that would just like have a machine and grind all day, right? He's like, I don't own farms, I don't own wheat, like I don't own any of that stuff. They're like, bring me your wheat, I'll grind it, I'll give you a sack of flour, and you owe me a small penny, right? He's not taking any risks, like I'm not growing the farm, I'm not getting all this special stuff and taking it to you, very little risk.
So like a full-fledged is like vertically integrated systems.
Yeah, or you just take on more risks. It could mean that you're more vertically integrated. It could mean that like, taking back to that same example of like wheat, he might say like, I'll come to your farm and I'll pick up your wheat for you. I'm taking on an additional risk. That means I have to buy a truck. That means if it spills, I'm liable for it, all that stuff, right? And so you increase that risk, right? that means you're probably going to ask for more money because it's like, I'm doing more things for you. You're adding more functions, risks. Key takeaway, right? Very simple. Less risk, fewer functions, less expected profit. Go ahead.
With specialization in manufacturing, like push you up that end of spectrum, where it'd be like with our Apple iPhone, like Chinese company, it'd be like if they made it so they can only make iPhones with their machines or something like that, like all our machines auto stamp the Apple logo onto stuff that they're like, okay, now we've increased risk, so we can't, sell our thing to Samsung anymore.
Love this. You guys are like right on this. So like you're asking the right questions, right? We're kind of gonna get to some of this later, and it's part of the case study. But part of your job as a transfer pricing person is to ask the right questions. It's easy to just sit there and be like, it's a factory. You guys churn out iPhones. Pretty simple. It doesn't take rocket science to understand what you're doing here. But then you start asking stuff like, well, those chips are really special. Do they take a lot of special knowledge to put them in? Or is it like a very repeatable process that every chip maker knows how to do? Oh, and they answer, oh yeah, it's really complicated. We actually have this patented process that you put it through lithography and you do all this stuff and no one else knows how to do it. Oh, well, who owns that knowledge? Oh, well, we do. Oh, so you're ratcheting up on that chain. You guys own that knowledge. Apple doesn't, somebody else does? Okay. And you have to license it? Great question, though. You're asking the right questions. Okay. Another core concept of transfer pricing. We talked about value creation, FAR analysis, routine versus non-routine. Now, this is probably a question that everyone wants to know. It's like you got the concepts as to like what direction things should go and asking the right questions of like where the value is created. But how do you actually decide how much that equates to? It's easy to say like, oh, well, you deserve the share. Okay, well, now it's time to split up the pie. How do you do that? There's this concept called the arm's length standard, right? This is kind of the underpinnings of all of transfer pricing. You might hear it called arm's length principle internationally. Here in the US, they call it the standard because we got to be different. Very much the same thing. But it's a concept that related companies must price transactions as if they were independent companies working with each other. Very simple concept, but interesting when actually put in practice, right? Even though we're related, even though I have my manufacturing facility that I own and I have my sales and marketing people in Ireland, when I buy that iPhone from them, I almost have to treat them like they're not owned by me. Like if I had to just go out and find someone that's not Apple to make an iPhone for me, how much would I charge them or how much would they charge me to get an iPhone made from them? Go ahead.
So did two like subsidiaries ever like barter with each other, or is it more just like it's the optics of it for government purposes and stuff?
It's a good question. It's more of like the concept. The yes and no. I mean, to say barter, right? Like depends on the company because some companies they look at management and performance metrics. Like all the people over in China want their bonus, right? They're like, well, I'm going to work very efficiently, and our profit and loss statement reflects how efficient we were at the company. So they don't want you to mess with their P&L sometimes, right? Because that messes with it when you change the transfer price. You can make their profit 20% or 10% by just changing the price like that. So yes, sometimes there's a little bit of friction intercompany, even though it's the same company. They're like, I don't want to do that much. Usually the tax departments win though. They're like, we want to set it at this price. Go ahead.
No, I think you answered it.
Oh, okay. Good question, though.
So sub question, does that mean that usually transfer pricing is standardized at like the main company, or do you have transfer pricing departments across different countries?
It's usually centralized.
Cool.
Yeah, great question too. I mean, local places will have their accountants and stuff, but
Yeah.
very much it'll be decided at a headquarter level.
Cool, thank you.
Yeah. So the standard is independent market behavior. We kind of talked about that. The goal is economic realism. Arm's length allows for a range of outcomes, not an exact price. That's a key component there. And our anchor is economic principles, not formulas. I say yet. I know it's like kind of a weird thing. Like there's talk currently out there on an international level where they're like, we should just make this a formula that everyone just follows. You're a manufacturer of like tangible goods of any kind, right? Like shampoo and conditioner and stuff. Oh, you fall in this category, and this means that you have to do cost plus 10%. Just end of story. Make it simple, right? No one's gonna really agree to that, in my opinion, but go ahead.
That were like discussion about like pillar two and
Exactly. You absolutely got it, right? So if you're curious about that, write that down. Pillar 1 and 2 is like an international movement to try and simplify some levels of transfer pricing because they're like international taxation has always been a hot topic, right? I guess a quick sidebar on that. I mean, this is a competitive environment. This is like something that I don't think people understand until they get into economics or and they get into business. You hear in the news all the time, they're just like, just raise the corporate tax rates. Like, we need more money as a country. We got a deficit. Just raise the corporate tax rates, charge Facebook and Amazon, all that stuff. They don't realize, right? It's a competitive environment. They do that. What do you think Apple's going to want to do? We go back to that P&L statement. If Ireland is saying, oh, don't worry, you guys, we're not going to move our tax rate. We like 15%. You think Apple's going to be like, oh, well, maybe we'll build our headquarters in Ireland, shift everyone over there. It literally means millions of dollars to us. It's not as simple as just saying raise the corporate tax rate. Like, all these countries compete with one another for business, for all of that stuff. So when you understand that concept, right, like, now you understand why countries will fight each other over these types of principles, because they all want their fair share for multinational companies that are making billions of dollars. Cool. Good stuff. Okay, so who sets the rules? Economics is not a definitive, I say unlike physics, it's not a definitive subject. Everything's up for interpretation. Reasonable people can disagree. So how do you ensure consistency with something that people could argue over for all time, right? There's no like single global authority for transfer pricing, but generally from my perspective and in my daily job, there's really just like two schools of thought, two rule books essentially that I kind of follow, even though there's lots of subsegments underneath it. You got the US government, because I sit in the US and I largely handle transfer pricing stuff for US based companies. IRS has rules called 1482 and penalty provisions in section 6662. That's essentially my rule book and Bible that I go by when I do my job to see like, what do the rules say, right? Pretty long. I don't know. It's like a couple hundred pages. Yes, I've read them. Most people read them. It's not the most exciting thing. It took me 10 years to get through most all of it, but some of it you just learn along the way. But you can peek at it if you want, right? And then international is what's called the OECD. You guys heard of the OECD before? Right? Sure. Organization of Economic Cooperation and Development. Very PC thing. They essentially set up a framework because they realize like a lot of these smaller countries, like in Europe, right? They don't have the resources like the US does. So they kind of get a bunch of people together and say, like, can we generally agree on something together and kind of put our efforts together? And then kind of like the euro, like same type of concepts. Like, we have an economic interest together. We're all pretty close together. Why don't we make a group of things that we generally rely on? So that's what they do. It's very similar to the IRS, but there's some differences. We kind of already addressed this. Anyone want to tackle that question?
so when they kind of came out, because like they've been kind of developing, they developed this like, or at least with Pillar 2 that's coming out, like that kind of came out last summer.
Yeah.
So I was with the company and they kind of tasked us interns with trying to find each country's CB or CR, which is completely different for each company. Like, and it's kind of hard to find. Like you could have like a company like Croatia, which has like there's different regulations, and they put the regulations in the Croatian dollar amounts, and that's very difficult to follow if company uses like a different like currency system. And then there's different, so it's not just the currencies, but there's different penalties, different fines, and each country is doing it in different ways. And so for large companies, say Coca-Cola, Microsoft, any of them, it's just not really feasible. Well, yeah, it really isn't feasible to follow every country's rule book, and most of the countries like the EU can't really enforce it.
Yeah.
So there's not much reason to actually follow the rule book for each country.
Yeah, so like kind of what he's getting at, right, is like there's an incentive for Europe in particular, right, because of how they're kind of structured, different from us, to kind of create a more globalized standard. The OECD guidelines is kind of that standard, but like I said, there's all these little subsegments underneath. You'll be surprised, like you'll get a country like France and they'll be like, oh yeah, we subscribe to OECD. Like they'll say it on their tax website. They're like, oh yeah, we follow these guidelines, except for this, 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 and this, and this. And every country will do that because they have their own interest. And so it's like, which is it kind of a thing, right? So it is a struggle because if you get a large enough company that has significant operations in each of these, it's like the compliance burden is just like beyond a reasonable amount. And they may even just like be like, we're just gonna have to pay penalties because we can't even cover all of it. So they might even set aside some money for it. But
So Matt, with that, then, is if you're not following these guidelines, either OECD or the US, the enforcement mechanism are penalties either through IRS lawsuits or through, how does the OECD close their?
so it'll be the local tax country. If they subscribe to OECD. The OECD guidelines don't prescribe penalties. That's up to the local country. So they'll have their own subsection for penalties. But yeah. So the IRS has 6662 is where they prescribe penalties, and they've got like all these ranges to say if your transfer price was above or below a 20% range of what we think it should be, it'll be X amount of dollars times X percent, gross negligence, all the legal stuff starts coming into play. Yeah, go ahead.
Sorry, quick question about OECD.
Yeah.
The IRS is funded by the US government. Is the OECD, like, does it take donations just from all the European countries or anyone that's still?
Good question. I don't know. I honestly don't know the whole ins and outs of necessarily how it's funded. My assumption is that each country probably funds it to a degree, or they agreed to fund it because they all benefit from it. How they do, I don't know.
38 member countries, US contributes about 20% of the total budget. Membership fee is calculated based on national economies.
There you go. Yeah. So yes, largely pretty close to that. It's like
They should be good at that.
even the US contributes to it, even though we've got our own rule book and we're like, we're not listening to that. And they fight over it, right? But it's an economic stage. We're all kind of in this together, right? Globalization. That's actually changing, right? I mean, anyone reading the news and stuff, it's like everyone tariffs, right? It's like everyone's taking a step back and be like, whoa, like maybe we want to be independent, or at least Trump's taking us that direction, right? Great news for me means I get a job. Like anytime there's conflict means I have more security. Just being honest, right? Yeah, I know it feels like that, but I always tell people like I feel pretty insulated because in good times, people have money to spend to optimize. So they bring me in and say, hey, help us make this more efficient because I got extra money and I could use some consultancy. Bad times are like, we can't afford penalties right now. We need you to come in and make sure you don't. Like, okay, I'll take that. Okay, now we're going to get into like more of the meat, right? We covered all the majority of the concepts, the core underlying pinnings of like what makes this work. I know I kind of skimmed over this, right? But it's like now we're getting into like how to actually do it, put pencil to paper and be like, how do you think about these things? I've got like a fun little, I had obviously way too much fun making all of these fun little cute logos, right? Like this is the vertical, the supply chain, right? All this stuff, some interchanges, factory interchanges, warehouse interchanges, all that fun stuff. Thanks. I just wanted to like pat myself on the back. You guys are funny. Okay. Transfer pricing methods are really, they kind of fork off into two basic areas, I'll call them. The first one is called transactional methods, and it's exactly what you would expect, right? If I tell you like, if I'm supposed to act as if this is a third party and I'm intercompany, I need to price something, what's probably the best way to go do it? You focus on transaction level data of things you can observe out in the actual market between actual third parties, right? So if like I'm looking to sell a car, or if I'm like Toyota and I just made a sweet Tacoma in Mexico and I need to sell it to the US for them to sell there, it's like, okay, well, how much are cars being sold that are similar to this truck in the open market for third parties, between third parties, at a wholesale level or something like that? Go ahead.
When you say like third parties, could you Are you saying like how much would that car have been sold in Mexico to a different company?
Yeah, or even cross-border. But when I say third parties as a terminology, sorry, I'm so used to saying it all the time, right? It's just meaning to say people that are not affiliated whatsoever. Like me and you. I want to sell you my truck. You know, you're an interested buyer, I'm an interested seller. I have no connection to you. It's what you're willing to pay and it's what I'm willing to sell for. Like an open market, right? So transactional methods look to actual transactions occurring out in the market. This is where we might kind of like breeze through some of these, right? Because essentially you have these 4 different methods, but they all work on the same underlying pinnings. They look at it slightly differently, but they're all based in the concept of going out into the market in databases and looking for deals that actually happen and the information is made public. So I'll take the first one as an example. We call it the CUP or the cut method, comparable uncontrolled price. Exactly what I'm describing. It compares the intercompany price between your company that you have control over to a price charged between 2 independent people in a very similar situation. So, I guess I'll use an example of like, say like a license to use the Nike logo, something like that. So I know I use so many examples, so I'm sorry if I'm like going all over the place, but like I'm Nike. I have a company in Cambodia. Did you say you're from Cambodia? Right. I have a company in Cambodia that is just going to sell my Nike clothing there locally. And I'm USA. I created the Nike swoosh. I own the branding and trademark. I want to charge, the Cambodian entity that's selling my clothes locally a royalty because I own the brand. And that clothing means nothing unless it has the swoosh on it, right? Otherwise, it's just a t-shirt, right? So in an intercompany transaction, you're like, how much should I charge as a royalty on the sale price of a t-shirt? If this t-shirt sold for $50, how much of a percentage should I charge Cambodia to use and put the brand that I designed on it? Between 2 third parties, you might actually have a really good example. I'm Nike, I do business with tons of people. Maybe there's a third party that wanted to license it. That's not Cambodia. That's not a Nike Cambodia. It's, I don't know, it's a Basketball Manufacturing Incorporated, totally unrelated to Nike, but they're like, we want to like sell Nike and we just want to use your logo on our t-shirt. And I sold it to them. I gave them a royalty of 15%. Sorry, go ahead.
Sorry, within that, since Nike is the one determining the royalty in both these situations, could Nike, like knowing that they're gonna have to deal with this, charge, Basketball's Unlimited 20% of the royalty? So it can do its internal royalties for 20% as well?
The whole point, yes, you're absolutely right. I mean, but the whole idea is that Basketball Incorporated, that third party, they are independent.
Right.
They're going to decide if they
And
want
that's
to
sort of-
take that deal or not, right? They're going to decide. And that's why it's like kind of seen as the ultimate pinnacle of like what is actually happening because it is with a third party. That basketball company would be like, dude, everyone here loves Nike. I don't care what it takes to get that royalty. Like if it means 50%, I can produce the shirt super cheap. So like if I'm giving away half to use a Nike, I'll sell through all of my shirts. So they might take the deal, right? But you might have a different country, right? Where it's like Nike's not that popular. Someone might want to like enter the market there and you can only command maybe a 10% royalty there. Now we're getting to some like differences, right? Is like you've got a universe of transactions with third parties. You bring them together and now you have to start saying, okay, what's similar and what's different, right? The market I said where it's 10%, I don't know. I can't think of a country that wouldn't like Nike, right? But maybe we take some African country that's never heard of Nike and they're like, I don't really care if it has a swoosh on it. I just want a shirt. I don't know. If Nike has operations there because they're manufacturing there, maybe you would use local comparables and you wouldn't charge the 50% royalty because it's not the same market, right? Selling a t-shirt in Africa is not the same as selling a t-shirt in Asia. So the royalty might be different. So you're asking, again, the right questions. It's not always as simple as just like, oh, I've got all this universe. I'm just going to stick them all in a spreadsheet and say 20%. It may be that easy, but not always. All the rest of these are basic just tweaks of this main concept. You're looking at transactional data and you're just including more data points in terms of like how much it costs to produce, adding a cost plus portion on it. If it's a services It's a service. We're talking intangible goods most of the time, but there's also services that are relied upon that, like customer service. You outsource people on the phone to answer stuff. These are like the preferred methods, I would say. Most of the time you want to do these, but the biggest difficulty about it is it's hard to find transactions because most of them are private. You know, like when you go to negotiate with somebody, it's not like you're broadcasting out to everyone all the time. That's like, oh, hey, everybody, I just agreed to do a 30% royalty with Nike. Everyone figure it out. It's like, no, most people like to keep some of that stuff private because it's a competitive advantage. You know, they have a friend there that's giving them a deal and they don't want to necessarily give that deal to everybody, that kind of stuff. So this is ideal, but it doesn't happen that often. Go ahead.
Sorry, I just wanted to go back to the first method. Just clarify, do companies ever look at, let's say, for example, the Nike example, would Nike be like, let's look at how Under Armour does it with Cambodia, or like how another similar company does a similar thing with a different country? Is that kind of like, is that used as well?
Yeah,
Space.
actually, so you're touching on a subject. I actually think I remember I have a slide that goes specific into some of these, but you're basically talking about difference between an internal and an external.
Okay.
You're describing external, and we've been describing internal the whole time. Nike's looking at its own agreements and saying, "Oh, we have 15 agreements with people that are not Nike, and we can construct a range, and so we know that we should charge our own company something similar." That's an internal comparable. External is like, okay, is there a database out there where I can have insight? Like, what did Under Armour charge something similar out in the market? Two totally unrelated parties, but Under Armour is very similar to Nike. They sell the same kind of clothes. They're in the same markets. That happens too. Yeah. Okay. Second branch of methods are profit-based methods. This is like you're moving away from transactional level data because it's either too hard to get, it's unreliable, it's not similar enough. And you're starting to look more of like, just in general, like what does the P&L, what does the income statement look like for companies engaged in this type of activity? This is probably like the favorite method of transfer pricing, the comparable profits method. So going back to our same example of Nike in Cambodia selling shirts, their functional profile is they're just a buy-sell distributor. They buy shirts and then resell them locally. That's it. That's their function. So a way that you could use a profit level base to say, okay, let's look all in Cambodia, find all other clothing retailers. They're selling similar types of products. We have their public financials because they have to report them. And we aggregate them, find the ones that look closest to our operations and see how much money are they making, roughly speaking. And you create a range and say, oh, most buy-sell distributors in Cambodia are earning 5% operating margins. Like, okay, so that means for our internal purposes, I should set my transfer pricings such that the underlying profit at the end of the day is 5%. A lot easier. You kind of circumnavigate some of the transaction level data, right? And just go straight to the heart of the matter, which is like how much profit is being left there. Go ahead.
You said this was the most popular way.
It's by and large the most popular.
Why do people choose other methods? This one seems so simple.
I guess what I should say, right, is there's an underpinning to the selection of method. It's called the best method. They're like, you have to, part of the rules say, you can't, here's all the methods you can use. You can't just pick and choose whichever one you want at any given time. You have to follow a rigorous set of like basically fact finding and ask the right questions. And so if transaction level data does exist, you can't just be like, it's too hard. I don't want to aggregate all that much data or go out and look at it. I just want to do a profits-based method because it's easier. You can't do that if the data exists and it's better. Right. So that's a good question. You have to go through what they call selection of method analysis too.
So for this one, for the operating margin, these ones, would it be looking at like an ROA or like ROE or like return on like over net sales type of thing? Or is it just kind of depend on the?
Absolutely. What you're describing, right? They're just different ratios that are used to evaluate a company. And depending on the activity, you might choose a different ratio over the other. I use operating profit because it's the simplest to maybe understand. But absolutely, if it's like a manufacturing type facility, you want to see what kind of return on assets they're making because they're an asset intensive business. So that's another part of your selection criteria is like, how do we best evaluate the performance of this company in general, right? So you have to ask that question too. Let's see. Oh, see, here you go. This is what we talked about, internal versus external, right? Very good. Okay, now we're getting to types, and this is where we're kind of getting into some of this stuff. So we're here till 6:30, right? Okay, we're doing great. I'm happy. We're doing great. I use a lot of our examples from tangible goods because I just think it's easier to concretely think about it, right? You think of like physical products moving through a system, but there's other instances of transfer prices that fall outside of that. You've got financing transactions where you've got some companies like in the US literally lending money to their companies overseas and saying like, oh, we're going to start up in Ireland. Here's $10 million, get started. That's a finance transaction and there's interest, all of those things. There's services components. So like I said earlier, there's like customer service or something, right? There might be a company that's like, we have high customer service needs. We're going to outsource it all to India and we're going to set up an entity there to do it, hire everyone. And that's all they do. And so India has to charge the US and be like, we're doing all these services. Tell us what we should be earning. And then intangibles, right? You've got the concept that like there's one entity that owns those intangibles, and wherever that intangible is owned and other people are using it cross border, there's going to have to be some kind of transfer price for the use of that too. Which do you guys think is the easiest and hardest to price and why out of these 4 categories? Okay, we'll start here.
I was gonna say intangibles.
Yeah, tell me why. What's your intuition on that one?
It's hard to figure out like where the source is and a lot of like things like brand. That's not like the brand doesn't come. I would say it. The company doesn't determine the brand, like the social receptivity determines the brand. So I think it'd be really difficult to be able to put like a price tag on that when like it's the public that's giving you the price.
Absolutely.
I also think like since this is the hybridization of like accounting and econ and finance, intangibles are the things that it's like the hardest to account for
Yep.
in accounting.
Because it changes, right?
Yeah.
It could change too. Yeah, and especially if it's like a homegrown thing. Who's accounting in here? Right? Yeah, I mean, when you acquire IP, right, you have to account for that under goodwill. Like when you have a purchase price and then anything that's between like the actual cost of that thing and then whatever it's valued at is called goodwill. But if you got something like developed in-house, you might have like capitalized R&D costs that are attributed to that IP, but for the most part, it's just like in the value of the company. It's like this thing, it's like it's valuable, it is, but yeah, how much? I don't know, Very good. Did you guys have anything to add to that?
No, I was just gonna add for the easier like to price was probably financing because there's just so many comps available for that. It's just like
Totally right.
total wealth of data percentages.
Good intuition on that too. Yeah, because I mean, any one of us can look up some pretty basic rates, right, for financing. That's not really secretive information. Most of it kind of funnels through from like government treasuries, SOFR, benchmark rates, and intercompany lending or bonds and all that stuff that they do. You're right. Totally public, usually not that difficult to price. So you're totally right. I don't actually, you're right. So like out of all the stuff that I do most of the time, yeah, you're right. It's mostly these 3. Well, I'll show you why for financing.
Sorry, which 3 were you circling?
Sorry, everything but financing.
Okay.
Yeah. So for tangible goods, physical assets, raw materials, inventory, these are the methods that are kind of available to use for them. This is a mixture of those transactional and profit-based methods. Here's that best method rule that you guys were kind of alluding to is like, well, why don't people just pick like the profits method? It's easiest, right? In selecting a method, the taxpayer must select a method that under the facts must provide the most reliable measure of an arm's length result. This is where we start to get into creativity, right? Who's supposed to say what's the most reliable? What does that mean? It's like you understand the concept. Yeah, I get it. But the argument behind it, I was like, what constitutes the most reliable method? Kind of up for grabs, right? So this is where you get creative in your writing, depending on like what type of story you're trying to illustrate with a company, right? Let's see, what's this last thing say? Okay, yeah, basics. We can go through some of the methods at a later point too, but these are what's available for tangible transactions. Financing, we already talked about what it is exactly, right? There's really only two methods that are basically there for that, right? A cut, meaning, comparable uncontrolled transactions, exactly like what we were describing. You go out in a database and you find, the US is lending $10 million to Ireland and it's structured this way, like this is the way they want to do it. Now I just have to go out to a database like Bloomberg, find all of the other other agreements that have a similar, volume of money, lending between maybe 8 and 12 million, similar size of company, similar credit rating, similar, all of the features that are basically the same, and then construct a range of rates. Say, well, they're all charging 5%, so you should charge 5%. The nice thing, what most people do is what they call safe harbor rates. Anytime you guys see like safe harbor and taxing rules, it's basically to say like, this happens enough that we've created like a default rate if you don't want to go through an analysis. And their default is like the US government says they publish rates, like I said, like treasuries and stuff like that. On their website, they have what they call an applicable federal rate. It's kind of a little separate, but it's still based on the same types of things. And they're like, just find your future term length, amount, and all this stuff. And whatever the rate says in this little table, you can use that and you're safe. So like takes 5 minutes, and then you know what it is and you can set it. That's just for US, by the way. International, they might have some different stuff. Tangibles, non-physical things. Yeah, I want to make a special point of this, like this first piece, because there's kind of two parts to intangibles in transfer pricing. We've been talking about more of like the use of something, right? Like US owns the brand and they license it out. There's a transfer in the sense that they're using it, right? So they have to pay for it through a royalty. But it's not there's separate too. It's a separate thing if like the US were going to say, I'm going to sell this intellectual property to Ireland. And you're like, why would they ever like want to do that? Like if they made the Nike swoosh in the US, why would they care to sell the swoosh to Ireland? And it's like there's that competition that takes place for taxation between Ireland and the US. They change rules all the time, especially with Trump, right? Like Trump in his first term changed a bunch of the taxation rules, and they do it on purpose because they want to repatriate. They like bring back business to the United States. So they make it favorable to own IP here. Oh, if you own your IP here, then we won't tax you this way, this way, this way, or this way. And companies look at that and they start salivating. They're like, oh my gosh, we should move our IP from Ireland, for foreign companies that have a US operations. Like, oh, we made this company in Ireland and the IP sitting there, but we should sell it to the US because we're going to save money that way, right? That's a different transaction, right? You're literally selling the IP, and others you're licensing it, which is like a transfer still, but it's not moving locations. It's just the use of, because it's intangible. Does that make sense? It's kind of two brands or flavors I'm talking about. Yeah.
Just a question about that. So like example, I guess going on with Nike. So if Nike has the swoosh rights in Ireland, does Nike have to like for example, is it Nike Ireland that owns that, or is it still Nike as a whole? It's just the rights are specifically. That makes sense.
You're talking more like the legal component of it,
Yeah.
kind of?
Yeah, do you have to divide the company into like, this is Nike United States, this is the Ireland, or do you just get to call it Nike? And then you get to keep stuff.
Yeah, you're kind of like delving, and this is why this is interdisciplinary, right? Because short answer is like, it's an asset, it's seen as an asset, right? You have to define what it is and where it exists and the boundaries of that intellectual property, right? Because you'll see, like, that's why they have names for like trademark, trade name, brand. Like those are all distinctions to say like where the IP starts and where it ends, what it entails and what it doesn't entail. You have an agreement in place that says, right, like this is what it means and this is where it sits. And you have to define it too. Legal entity, a location. That's where like lawyers get involved to kind of draft that stuff up. Does that answer your question?
Yeah.
Okay.
Thank you.
So I don't want people to get confused, right? Like I've done both transactions, right? I've had companies come to me with that second example where they're like, oh, the US is like a safe haven for IP right now. We have all this IP in Ireland. We want to sell it to the US. Tell us how much we have to sell it for. And those are big things, right? Like in the open market, that's like the equivalent of a company like going IPO or like saying something like, oh, we're selling out. We're gonna get bought out by Under Armour. We're gonna merge. So they're like, oh gosh, like I have to value the swoosh logo, how much is Nike worth? I've done that just at a smaller scale for like software companies, right? When they build a product. And I've done the other where it's just licensing or something like that. Those are the methods: cut, CPM, profit split method. There's some of that difficulty we were talking about. If it's really unique, how do you know what someone would pay for it? Say if no comparable transaction exists, what does arm's length even mean? I just mean to say like this is kind of leading into that, like why is this so difficult for IP? And it's because these types of things happen. It's like if there's nothing out there that shows, or this is a new product that's never existed, how am I supposed to price it? You start to bring in accounting and finance concepts like valuations, right? You're like, well, time to break out a DCF, figure out what the profit potential is of this thing, forecast it out 5 years, discount it back, get a whack rate. That's where you start to get all that stuff because it's the equivalent. It's like a transaction. Services. And services get interesting too. There's this concept of like a benefits test. All it's really saying is just that if one entity is performing services on behalf of the other, it has to actually be beneficial for the company. That sounds ridiculous, right? It's like it has to actually be beneficial. It's like, well, wouldn't it be? Not always. They define some things that's like, no, that's not really like a beneficial. They'd have to be willing to pay a third party to do it. That's kind of the test, is like, if it's an activity that you'd have to do no matter what, and you're just deciding to do it intercompany, then that's chargeable. If it's something you could care less that they do, then you're not allowed to charge for it. It has to just be like an expense they have. So it's like these are essentially the non-chargeable services. They don't really make sense on a surface value. You have to read what they mean by these types of things. I think the easiest definition is like when you have like a board of directors and you've got like an accounting team in the US that's like putting together slide decks for board meetings to make executive decisions and stuff. They can't charge that to other affiliates because they're like, I'm not going to be part of that board meeting. I'm not going to use that deck or materials. Like, I wouldn't pay anyone for that. If you're going to like help me figure out how much to pay my people and you're helping me with payroll and benefits, yeah, absolutely. I need that. Right. So they've defined activities that you can and can't charge for. And so all they're doing is like, when you're looking at services that are going cross border, you have to run this benefits test, make sure it's actually be something people pay for. And if it falls under one of these things, you can't charge for it. So they just put guardrails around it. I guess like to kind of conceptually bring like, why is that a problem? It's like, why would this be a problem? They have to put guardrails. What's the problem, right? You might get companies that might inflate the charge price and just dump a bunch of stuff in there because they're trying to shift profits from one jurisdiction to another. Like, oh, we're doing all this activity and cost plus 10% and all that stuff. And they're like, hold on, like, show me what all this activity means. And they're like, you going to get your lunch and stuff like that. Come on, like, no one's going to pay you to do that. It's like a dumb example. Okay, when one company like accounting, there's all the methods. A lot of them. What?
Nothing.
Just like lots of different methods or what? SCM is like a special method. You can look this up different. This is just specific to US. Some services, they're like, you don't have to have like a profit component to it. You can just charge it at cost. Okay, we'll just have like a quick test. Which of these do you think would pass a benefits test, right? Payroll processing, board meetings. I already gave it away. I'm sorry. I already said like board meetings.
Is there any way that you can, like the automatic ones that you automatically can't charge, is there any way you can justify those into? Like, can you go back to the previous slide?
Yeah.
So like with the like shareholder activities or like duplicative activities, or like indirect and remote benefits, is there any way that you can justify it to become a chargeable service? Or once it's in the non-chargeable services, automatically you just can't move it regardless?
You're kind of asking almost like a circular question because it's like if let's like take duplicative for an example. Like, so I'm the US and I have a customer service team in India,
Right.
right? I have my own customer service team here, like that also addresses people in the US. Now, that's a really simple example because it's like only one call can be fielded at a time, right? It's either going to me or it's going to the US. So like in that sense, like if I'm doing all of the customer activities myself and I have my activity here and I don't use them at all, they can't charge me for their service because I'm effectively not using them.
Hmm.
Or if they were, it'd be like, I think it's a bad example, but it's like duplicative. If you're going to make an argument that says like, oh, it's not duplicative, then you'd have to say something like, well, my team here only fields half the calls. They field the other half. So for the half that they cover, they can charge me for it because if it weren't for them, I'd have to hire more people.
Yeah.
Something like that.
Okay, cool.
So like this again, more of an argument of like when you're going to say, oh, this counts, oh, this doesn't count. It can depend a lot. You just have to lay it out.
Okay, cool. Thank you.
Good question. Was yours kind of answered too on the same thing there? Okay, so we kind of went through that, right? You know, people have to do payroll, otherwise people don't get paid. Passes a benefits test. I already said board meetings because those are more like executive level functions, something that an entity in Cambodia doesn't need to operate, right? They don't need to have the board meetings. They just get told what to do. Executive management, they set strategy, right? They tell Cambodia what to do. So they can charge them for that service. That's kind of funny. Okay, so now we're getting to like 20 minutes left. I want some questions. This is like a light case study. This is just supposed to kind of bring concepts together, get people's brains working. But honestly, you guys have been already asking the right questions and everything. It's just probably laying it out in just more simple, concrete example, right? So just a quick recap. Value creation, FAR analysis, routine versus non-routine profits, arm's length standards and regulations that govern it, common transfer pricing methods. I know we zoomed through that. You know, I could spend a class on each one of those methods alone. They have that much detail. So that's why I spun through it. I highly recommend, you know, for your own sake, like when we get more into the actual competition type stuff, just either having conversations with ChatGPT of like, help explain to me what this method means and how you do it, you know, but you at least have like the terminology and everything that it'll lead you in the right direction. You can look up stuff. But this one's just bringing it all together. Okay, golf. I still don't golf. I golf like once a year. This was Steve Cullimore, my former partner. He golfs a lot, so he wanted to make a golf case study, of course, right? But we're gonna use it. So Silver Fox Golf US is a Utah-based company. They design and manufacture golf equipment here in the US. They sell them here to the local market. Now recently, they're like, we think we have a market in Europe, so we're gonna form an Irish entity called SFG Ireland. Now we operate across multiple entities and jurisdictions, and now we need some transfer pricing policies in place because we set up shop. Okay, so here's like the basic functional profile of the US, right? I kind of already said that. They design and manufacture here. So they've got the company that helps make it for them. They've got their designers that make cool logos, all of that stuff. They've got club technology, IP rights. They provide strategic operational and support services. You can see them as the headquarters. They've got their C-suite and other people. Ireland, their job so far is they're supposed to market and sell. They purchase directly from the US and no one else. They rely on the US for all of these other ancillary services. They're small, right? Like maybe they're an office of 10 people. They're just concerned with selling. So all of their legal needs, HR, any strategy, they have to call up the US and say, hey, what are we doing? We don't have legal people. And they were financed initially through an intercompany loan to get started. So they set up shop and US said, here's 10 million bucks, go get started. And they also use the brand and logo. I may come back to this. You don't have to like absorb this all right now, but this is kind of an idea to show like headcount and footprint. We do this all the time. We ask them for headcount charts because this doesn't lie, right? You'll be surprised how often we'll talk to a company, someone that's been there 10 years and be like, tell me what Ireland's up to. They're like, no. You're like, yeah, but I mean, don't you like fly there once a month or something like that? They're like, yeah, but I mean, I talked to like 3 guys. So like, like, okay, like get me a headcount chart and we'll start asking questions, right? So here you can see, right? Ireland doesn't have any executives. They may have one finance person so they can file their taxes, no legal, no HR, one IT person to make sure their computers work, all of that stuff, right? But you can tell just key, mostly US, some over there, proportion. Okay, so what are we being asked to do as transfer pricing advisors? Identify intercompany transactions, because sometimes they don't even know, right? Like they don't even know sometimes, like, oh, you mean I have to charge for my brand? Like, yeah, you do. Sorry. Apply an FAR analysis to each entity, determine which activities are routine, which ones are non-routine, consider which transfer pricing methods might apply and why. That's our whole job from start to finish. So, I think it was you, Kenny? You kind of alluded to this earlier. You were asking some of the right questions, or I said you're asking the right questions. I gave you some layout. You're sitting down with these guys now, and you're like, that's our job, right? This is what we're supposed to be doing as transfer pricing people. I've got a general idea. What kind of questions would you guys answer when you're sitting down with them? You get to fly all the way to Ireland and you sit down with Ireland. What kind of questions are you going to ask them? Remember, functions, assets, risks. Go ahead.
I want to ask for like, because it mentions that they sell what is it, the golf clubs or something. So I want to ask them like if they have like a buyback initiative with the US, so, like if they have any risk that like when inventory comes over to Ireland, if it doesn't get sold, does it go back to the US like at no cost to Ireland, or does it stay in Ireland until it gets sold?
Awesome question. Wow. That was like home run right out of the gate. Because what are you getting at with that? You're like, who's holding the risk here? Obviously, the Ireland like buys it from you, but like if you can't sell it and it's just sitting in your warehouse, that warehouse costs money. So, is there any buyback provisions in place? What happens to inventory that you can't sell? Does Ireland have to pay for that, or does the US reimburse you for it and be like, sorry, our bad. We gave you bad projections. We sent you too much, right? Great question. Any other things? Think about functions, asset, risk. So yours kind of covered a little bit of assets and risk, mostly risk.
I mean, is Ireland generating any unique assets or they just purchase them all from US? Like it sounds like they're just buying all of their assets
Yeah,
other than like their people.
yeah. Question. So you kind of maybe like, I'll turn your question a little bit more, but it's like a more tailored question. Is like, do you guys have developers there that have input to the technology?
Yeah.
Right? Because you guys are selling it to people. Do you have golfers coming back and being like, this follow through sucks? The head's shaped weird. You guys should change it this way. And they've got an engineer over there that's like, oh, yeah, let me write all this down and think of some ways to change it. That's an IP generating activity, right? They may not even know it. They're just like, oh, we should get an engineer over there because we're getting lots of feedback in Ireland and it's good, right? So, great question. Can anyone think of one maybe on the assets? Kind of covered some function. I guess that's part assets too, right? Because you're generating IP.
It'd be like a data thing where like, what data are you guys collecting? Is the data housed in Ireland or is it housed in Utah? And then like who are the analysts, I guess, that are looking at that and how are they manipulating the way they're looking at the data, that kind of thing.
You guys can come work right now. You guys just want to graduate and come work because you guys are hitting all these are questions, right? Like absolutely, especially with data, because there's all sorts of regulations around data, right? Especially with customer data, right? It's like you got their name, you got their billing address, you got their credit cards, you got all sorts of stuff. Asking that question and be like, does Ireland hold on to that data and secure it? Or do they put it in a database that sits in the cloud that the US controls? Where's that division, right? Because if Ireland is taking on some of that risk, changes their profile, right? Again, so that is like part assets and risks again, what do they hold and what do they have? You guys are great. Like these are all perfect questions to ask that people just honestly don't think about, right? Because most of the time the executives, right, they're just concerned about making the business make money, right? They're worried about operations, this stuff on the back end with tax and everything, it's kind of an afterthought. So it's often we come in on the back end, we start asking these questions, and sometimes it's not always the answer they want, right? We're creating tax headaches. Like your IP question, I've had that happen before. We ask the right questions, we discover you guys just created an intangible here. You got to define it now, and you might have to license it back to the US because the US is using it. And like, and it creates a bad tax answer for them. And they're just like, oh, like that sucks. So you really? I'm like, yeah, absolutely. If the tax authority gets wind of it and you're not doing this, they're gonna say, hey, we deserve more profit here because you got this asset. I'll just kind of skip to, some questions, right? These are just a series of examples, right? Who decides what products features? Who sets the pricing in each market from a sales perspective? Who owns the inventory? That was your question, right? And at what stages? Who owns the relationships? You guys, we already covered all of these. You guys got them. Who absorbs losses if products don't sell? Same your question that you had. And bears foreign exchange risk. You've got Irish currency, US currency. So once you get all this analysis done, right? Now you have all the information to start saying, okay, let's characterize. Let's establish how these operate and who's doing more routine versus non-routine, what methods seem appropriate. You got to start with this, lay the foundation, then you can start overlaying transfer pricing on top of it. So, okay. We may have gone quickly over the methods, so maybe this doesn't work as well because I had to kind of zoom through it. I was going to ask what you guys think might work for a good methodology to cover this type of stuff, but we're just going to go straight into it. Sale of golf equipment. Up, meaning you just look for other examples of people selling golf clubs in the third party market. Honestly, probably hard to find. It's not like I'm going to go out to the exporting goods and start thinking how much do you guys charge if you have to ship this overseas to someone or something like I'm not going to do that. No one's going to do that, right? So honestly, you start with the hierarchy, like I told you, they always prefer a cup, but if you can quickly answer, it's like the data is just probably not there, or you demonstrate that the data is not there, then it's like, okay, we'll go to a profit-based method because that's easier. I can look at retailers of golf clubs pretty easily. Services, I'll just skip past that. We already talked about probably the difficulty. Technology or intangibles are probably the harder ones. Okay. We got 12 minutes. I feel good. We just got through everything on time, pretty much, with time to spare. And, great questions, you guys. So yeah, let's open it up and we can go back into the deck for certain areas if you want to cover more of the methods. If you want to go back to more of the fundamental questions, any economic principles, legal aspects, let's open it up. No, or if there's no questions, that means we did our job, right? Go ahead.
Just about the transfer pricing for financing.
Yeah.
Is that simply just because interest expense will hit earnings and that's what they can tax on?
Exactly. Yeah, it's all comes because interest is deductible.
Gotcha.
Right? Interest expense comes out of your taxable profits. And so, that rate that you set and how much the underlying base is subject to review because it can affect it. That's why you can't, if it's like a small entity, you can't just say oh, we're going to give you a loan for $500 million. Because it's the reasonable expectation that a third party would get that much money out of thin air. That's not going to happen, right? They're like, you're tiny. You don't have any operations. The most we can give you is $1 million, So yeah, they care about that for all those reasons. You can't just use it as a siphon for interest expense. Yeah, good question. Go ahead.
So most of transfer pricing from what I've heard is based on international transactions, but I've also heard of firms that specialize in just United States specific transactions. Does your firm do any interstate transactions where you're having to deal with different state tax rates?
Yes, although very, very rare. So the US under taxation laws regarding state tax, right, or local taxes, because each state can levy their own taxes depending on the economic activity. There's a unitary system. I don't know a whole lot about it because again, I'm not that kind of a tax expert, but they all kind of unify and they make apportionment rules for profits earned in each state. So most of the time that apportionment rule, and I'm really oversimplifying it, right? Essentially eliminates the need for transfer pricing in a lot of aspects on a state by state basis. But it comes up for very unique things where there's not an apportionment or it's like a very specialized tax for a specific product that isn't the same in every state. An example is I have a client right now that's in cannabis, very contentious tax wise kind of industry, right? In New Jersey, they have a rule that says like if you're going to grow cannabis in state, you can only sell it to a dispensary also in state. Because right now there's like rules, right? Like they don't like it going cross border because some states are like, you're not selling cannabis here, right? So they have that rule, and then they also want to tax it because it's a valuable industry now. So they levy a special tax of that sale price between the cultivator and the one selling it to consumers. So I have a project like that for transfer pricing. It's all US, but they're like, basically, they're like, they levy like a 2% tax on that price. So they're like, what's like the lowest price we can charge to not have to pay high amount of that 2% tax on that transfer price? So we do an analysis, we tell them. Great question. It doesn't come up often just because it doesn't, it's usually very unique things, probably for weird industries like cannabis or crypto or stuff like that. Yeah, go ahead.
I know a lot of time with like finance or accounting, you have different like managerial practices you can do to like adjust the way that stuff shows up on your earnings, like first in, first out versus like first and last out.
Mhm.
And typically you have to be able to like justify maintaining that. With transfer pricing, since a lot of these like the routine transactions are repeatedly occurring, do you have to justify if you want to switch your valuation method or if you want to switch like let's say that you're doing it at like a 10% profit in one country, do you have to justify it if you want to switch to like 12 or 13?
Okay, so you're saying like they want to switch like their
Yeah. And then
their
like with the
benchmark.
IRS come in there and be like, yo, what changed?
Yeah,
Because you like it used to be 10%, now you're doing 15.
yeah.
Or are they more relaxed with that?
So there's kind of like two parts to that. So in some of these methods or like the profit-based methods, it's not always a point estimate. There's a range. There's an interquartile range.
Yeah.
So like for an activity like distribution, it can be a range from like 5% to 10%. And the company will end up somewhere and they'll target, say, in the middle, like 7%. But any given year, they might be 5, and the other year, they might be 10. The idea that the governments care about is that they just fit in that range. So that's like the lower kind of like quick answer to that. The more extended answer is like if the company is saying like, yeah, hey, we're going to revisit our functions asset risk analysis. We put more function here in this entity because it's growing. We need to revisit our transfer pricing because that model doesn't work anymore. Then you document it and you basically explain like they used to do this method and they used to get a 10%. Now they've got more activity here. They've got more revenue generating activities. We reran an analysis. Now we think they deserve 15%, and here's why. And that's your case, is like you have to document it. Yeah.
When you're like when someone's coming up with these strategies, right, and coming up with these pricing,
Yeah.
and you come up with the proof for it or the reasonings, do you have to present that to someone before implementing it, or do you do it just in case the government inspects you one day and they have to look at the reasoning for it?
Great question. I mean, you're kind of putting your consultancy hat on right now because at least in the US, right, you need documentation to prevent penalties. You don't have to do it. Technically, they don't say like, you have to do your tax return every year. Like there's no option there. You have to do it. Transfer pricing documentation, they don't say anywhere it's like you have to do it. No ifs or buts. It's a compliance feature. So companies can elect to do it or not to do it, right? But what we tell them, right, it's dependent on their case. It's usually a mixture of like, how much volume are you doing? Kind of like, I don't know if I'm thinking of like individual taxes and it's like I got my day job, but I also walk dogs on the side and I collect money from that. Technically, you should always claim that, right? But the government also sets limits on that. They're like, if you're making less than, what is it, like $6,000 a year or something? I don't know. I'm not a specialist in personal taxes, right? But they set limits and they're like, if it's below this, like, you don't have to claim it. You don't have to put it on your tax return. That's the kind of discussion we have with clients when they're coming to us. And we lead with saying like, if you want penalty protection, if the IRS comes knocking and you don't have this, you're open for penalties and there's nothing you can do about it. If you do have this paper and you do have a study, you at least have a seat at the table to say, like, before you impose a penalty, I've got something that defends my position. So, does that answer your question?
It does. Thank you.
Yeah.
Yeah.
Different countries have different things. Other countries require it over like a certain limit. Like I said, they're like, if you have an intercompany transaction that exceeds $100,000 in a fiscal year, you need it. No ifs or buts. Others say like, you don't need it. There's no threshold either. But if we ask you for it, you have to prepare it within 60 days. Yeah. So there's companies out there that'll be like, okay, great, I don't have to worry about it. And if it does happen, I'm gonna call Matt up and say, hey, I need you to prepare this in 60 days. Can you do that? Like, so it'll cost you. Yeah, I can, but it'll cost you. Yeah. Any questions? Go ahead.
I know right now companies are doing, you have pillar one, pillar two, and global alternative minimum tax, to stop that transfer pricing problems. Or even corporations, you have the corporate alternative minimum tax.
Yeah.
What would you say is a very hot topic right now that companies are doing to get around that loopholes? Because there's always planners out there, tax planners, to try to get around that. Do you see any prevalent situations right now that are trying to get around those rules? And
So, I mean, like pillar one and pillar two, it's being adopted, but it's not universally adopted yet. So really, like, I mean, they have slated some parts of it that they're trying to make like official, like you have to start following these rules starting in like 2026 or whatever.
but the US isn't doing it, right?
No, they're not.
The two, right?
Yeah, they're not. They're not subscribing to it. So it's very much still like under argument.
Yeah.
People are really talking about it. You remember from my other slide, I said like this isn't formulaic, or this isn't formulaic yet. They're trying to start with like the easiest transactions first, the stuff that happens all the time. They're like, let's start with the easy stuff, tangible goods transactions, distribution transactions. Let's create a table and just say like you follow this formula. And if you meet it, great. If you don't, you have to make some adjustments. That's being adopted, but even people are arguing about that. I honestly don't know if it'll be full sweep adoption. But that's the hot topic. I mean, you touched it. You said, what's the hot topic? That's the hot topic is like, is it gonna make it or not?
Oh, really?
I don't know. People don't really know. Well, there's more nuance to it, but look it up. Couple more minutes. I'll just say, like, if you have questions, feel free to email me. You guys have this deck. It has my email on it, right? If you have different questions about it. The case study, right, will touch on all of these topics. It'll ask you to kind of dig in a little bit more. But the creative questions that you guys are asking, right, will help demonstrate in your case study like your natural intuition for getting to the right answer. And the actual like doing the calculating part, there's like some creativity to that. So when you get to that stuff, I know you guys have mentors, right?
Yeah, so here's the roadmap going forward. So in 2 weeks, we're going to meet March 12th. That's our next meeting. At that time, there's a few that weren't able to make it here today. So we'll get here. We'll have mentors in person, mentors remote. So we'll form our teams, and I think we're going to give them the case at that time. Yeah. And so the teams will be, we're not sure exactly how we're going to choose them, but it's going to be interdisciplinary. So you may or may not get to choose your own teams. I know we're going to break the accounting guys up. That's maybe not. We'll see. It depends how much contributions we get. And so we will form teams and assign mentors. And then it'll be another 2 weeks or another week we meet on the 19th. And then April 2nd will be the final meeting where we'll present the case, have a networking event with a lot of alumni here to talk, to see your presentations and go with awards.